Hi, Anthony. Thanks for joining us today.
Thanks, Dharmo.
Given that there's so much uncertainty today in the world, whether we have people concerned about recession, about inflation, what's the outlook for global equities and why should investors be overweight equities in their portfolios today?
Equities have had a very strange ride in the last couple of years. Last year down 15%. This year so far up around about 15%. Net, they're actually down. So since the beginning of 2022, equities are down 3-4%. This year, the headlines have been made by what's known as the Magnificent Seven, which is 7 big technology companies which have performed incredibly well. In fact, the 7 companies account for about 70% of all that performance. So the rest of the companies are up only about 5%. So I think when investors look at the headlines, they need to bear in mind that there's some interesting thoughts behind those headlines, which mean that the rest of the market has barely gone up at all. So our view remains, as it did last year, that our outlook for equities is currently positive. The big fall last year was caused by high inflation, which led to high interest rates. Inflation has stabilized, and interest rates are at least stable, if not heading down by the end of the year. So we think the outlook generally for equities is pretty good, but in particular for certain kinds of equities, which we call quality equities, which are companies which earn very high returns on investment and continue to earn those going forward, so they're sustainable. Those kind of companies have shown in the past that they can weather all sorts of economic climates and still do very well. So we would focus at the moment on that kind of company.
Lazard has been working with UOB Asset Management on the Global Quality Fund. How does quality investing differ from other global equity investment strategies?
Growth and value are undoubtedly the two sort of most famous styles. But we've done a lot of academic work which sits behind our global quality growth portfolio, which shows that over long periods and over individual investment cycles, an investment in quality companies does better than either growth or value. So what do we mean by quality? Well, we mean great companies that can grow the value of their business by generating high returns now and reinvesting their cash at increasingly higher returns. So they're compounding up the value of the business. We think those companies, and those companies have proven to do better than either growth or value. Because growth is similar to quality, but doesn't necessarily have profitability and cash generation behind it. So we're more conservative than a pure growth investor who just looks at revenue and sales and expects profits sometime to follow. And in terms of value, they tend to be very cyclical businesses, subject to the economic cycle or commodity price cycle. And we tend not to like those because they're not very predictable. They're dependent on big external variables like oil prices.
So what specific criteria does Lazard use to identify quality stocks in the market?
Yeah, that's a very good question. There are a number of, I suppose, commonly understood definitions of quality. So the MSCI, the big index provider, has a quality index, and they look at return on equity in the past. And they look at 5-year earnings growth, again, backward looking in the past. And they look for companies with relatively low gearing or low debt, again, looking backwards. We accept those definitions, but we add to them. Because we are fundamental active investors, we're constantly looking forwards, and we have 4 key questions that we seek to answer. One is, how does the company generate high returns? How has it done it so far? The second is, how much longer can we expect that to happen? The third is, what are management going to do to generate those higher returns in the future? Where are they going to invest the cash flow that the business throws out? And then the final one is valuation. How much of that future is already discounted in the price? So we find great companies, but sometimes they're already overvalued. They're already at a place where the market has recognized their future potential. So there's a lot of work goes on taking the current situation of a company and then forecasting it out into the future.
Give us an example. I mean, what sort of company would you look for, and what is in the portfolio today?
One of the companies in the portfolio right now is a company in the pharmaceuticals area or healthcare called IQVIA. Now, IQVIA doesn't make or sell drugs or medical products. What it does is provide services to big pharmaceutical companies, which help them to save money and save time. And that's important because when you develop a new drug, you get a patent. And that patent protection is very important to profitability. But what makes it a quality company is the fact that the management of the company has been able to take those advantages and create very high levels of what we call cash flow return on investment, which is a measure of the profitability of the business and the returns it makes to shareholders, but it's measured in cash terms. And that makes it much purer when we look at it. We want companies that generate cash because they can then reinvest that cash at the existing high rates of return or higher, and therefore compound up the value of the business.
Given this bottom-up approach, what's the composition of the fund relative to the global benchmark?
Yeah. Well, while we're happy to be measured in performance terms against the MSCI All Country World Index, it doesn't have any influence on the way we construct the portfolio.
Right.
It's very much what we call bottom-up portfolio, i.e. it's all about finding the individual stocks.
Sure.
Every single stock in the portfolio we expect to do well. So we don't buy anything just because it's a big company, just because it's big in the index. We have a higher weighting towards some IT companies, particularly in the semiconductor and software space. So companies like Microsoft, companies like TSMC, the Taiwanese semiconductor business. We also have a relatively high weighting in industrials. Now, by industrials, that's what the MSCI calls it, but we're not talking here about smokestack industries. We're not talking about steel companies. We're talking about people who supply services to industrial companies. Where we don't have exposure is in energy, real estate, utilities, and materials. And the reason for that is we can't find any great companies in those sectors. Typically because those sectors the performance is dictated by a big external factor over which the management can't have any control. So oil prices and gas prices for energy, commodity prices for materials companies, interest rates for real estate. And with utilities, they typically have regulated rates of return. So they can't produce the supernormal returns that we're looking for. So we almost never have weightings in any of those because they simply don't meet our definition of being great companies.
Considering current interest rates, investors are taking relatively more risk than before for the same equity returns. I mean, after all, investors can get decent returns from cash deposits today. Why take the additional risk by investing in equities?
I think as a general principle, we always advise any investor to have a diversified portfolio, to have representation in different asset classes. And cash returns at the moment look attractive, certainly compared to the last 20 years. And so we wouldn't say, oh, don't have any cash. But I think it's important to recognize that historically, cash has not been good at producing real returns, i.e. greater than inflation, whereas equities have. So if you're looking to protect the value of your investment in real terms, to be able to buy as much with it in the future as you could today, then you need to be looking at equities.